Okay, we are back on Today with Denny, and I always love to have this next guest on here, Mr. Paul Meeks. Paul, are you on the line, Paul?
Yes, sir.
Awesome, folks. If you don't know, Paul is arguably one of the most successful fund managers in history. He ran the largest technology fund in his days of Merrill Lynch of about $8 billion. I'm so blessed to partner with him. He helps clients. He's part of Independent Solutions, a great RIA with a private wealth group. And Paul, I think we should talk today. Well, whatever you want to talk about, I'm listening. But I want to kind of talk about the inflation because Chairman Powell is kind of downplaying it. He was quoted as saying, "Well, we're not going to see what we saw in the '70s and '80s," and I'm like, "Well, that's not a great comparison. We better not see 14 and 18%." But he kind of thinks that the shortages happening now between cars, chips, and workers will fade over time. We should go back to 2%. But the fact of the matter is, we saw 5% in May, and I don't see house prices shrinking anytime soon. So what is your take on inflation going forward?
So, first of all, you've hit the nail on the head. It's clearly, in my view, the most important variable.
Mm-hmm.
When you take a look at investments, there's all kinds of macro, big picture stuff and micro, small picture stuff. But man, the macro is trumping the micro, and the king of all macro issues is inflation. And so there's two schools of thought. The bulls believe, and this is what Fed Chairman Jay Powell is rooting for, that the only reason we have inflation, which is undeniable, we've had pretty big consumer price index readings the last 2 months,
Yes,
is because we have pent-up demand. We're reopening the U.S. economy, and we don't have a supply chain that has caught up just yet to the demand. All right, hope so, because the bearish argument is that we are seeing inflation that's not short-term, but it's actually long-term or structural. And if that's the case, that could be bad. And I don't think that inflation a la 1980, when inflation actually briefly got up to about 15%, is in the cards. But I do believe that if it is long-lasting, even at this heightened level, that there could be some hell to pay. The way I come out on this is not to half-ass it, but I am worried, and I'm waiting for more data.
right.
I hope the Fed and the bulls are right, but as of now, I've been positioning portfolios not for Armageddon, but for turbulence. So I've downplayed tech and growth stocks, even though that's kind of what has brought me to the dance over my career. And I've emphasized dividend-paying, steadier stocks that should do better in this environment, particularly stocks in a couple sectors of the economy, including materials, financials, industrials, energy. You could actually make the case that companies in those four sectors of the U.S. economy may actually get a benefit from inflation versus most of the other companies in other sectors of the economy could get dinged.
Well, they're in sectors that we're going to utilize. But one other thing I love our conversations because I learn from you. One other factor, obviously, is did you ever think, I certainly haven't thought about, that I would live to see that we've spent roughly $10 trillion in the last 12 months? I mean, that is such an astronomical figure. How could that not affect inflation in the intermediate, possibly the long term?
And that's why, Denny, I'm kind of playing this until proven differently on the cautious bearish side, because $10 trillion, which is what the U.S. government has thrown at us ever since the beginning of COVID through two different means. One is monetary policy, which is controlled by the Federal Reserve Board, our central bank. And the other one is your buddies in Congress in Washington, D.C. They control tax and spend, in this case, the spend, which is called fiscal policy. So between those two, it's about $10 trillion And to put that in perspective, in 2019, before we got hit by COVID, the U.S. economy, number one in the world, was a $22 trillion economy.
Exactly.
So $10 trillion is a little bit less than half of that. That is a lot of stimulus. And over the long term, yes, that can be scary inflationary.
Well, the thing about it is I love the fact that, yes, you have these dividend models where you buy equities that are already yielding between 2 and 3% with about a 5% upside potential. Because let's face it, bonds are not sexy now, nor they will be in the immediate future, will they, with the way things are?
Yeah, at some point, if inflation continues,
yes,
which means interest rates will rise in response, which means the coupons that you are paid and earn on buying bonds will rise. So at some point, if this trend continues, the coupons on bonds will be high enough. So they yield a lot more than alternative investments, but that's not the case right now.
Right.
Because interest rates have come from essentially zero. So while climbing, the typical interest rate on a bond, 2 or 3%, is still going to be probably less than a dividend that you can find on a stock. And that stock has price appreciation potential, whereas the bond could actually lose principal value as interest rates rise. So yeah, I still think that bonds are pretty much uninvestable, even for conservative investors, older investors.
Mm-hmm.
And I would just focus on a portfolio of U.S. stocks because I still like the region relative to the rest of the world of dividend-paying companies that all have dividend yields of 2 or 3% at least. And they're in those targeted sectors that I told you about that either benefit from inflation or get less hurt from it.
I don't know why CNBC doesn't feature your knowledge. They just, I always say Paul does more than growth. And in these times, investors need to rebalance their portfolios. They need to understand from your point of view that it's, especially if you're already retired, you need to watch your dollars and cents, folks. And you need to consider planning for what could happen. And but they're not interested in that, Paul. They want you to talk about these high flyers because I think most people, they're just interested in big time growth. The music's playing, it's never going to stop, and we're just going to keep dancing.
Yeah, tech will have its day again because these are America's most innovative companies, and of course they're special.
Sure.
I grant that, but I'm just a little bit worried about the macro backdrop, nothing to do with the micro. Most of the tech companies I follow continue, even in the teeth of this thing, to report revenues and earnings much better than forecasted, and they guide for the next quarter to more of the same. So not a fundamental issue at all.
Well, hey, I think we should fly you down there, have a conference for investors wanting to hear from you. We can play some music, have some fun, maybe even fly in Charlie Speraza, and he'll do all the cooking.
All right.
So, Paul, it's always a pleasure. I know how busy you are. Folks, if you'd like to know more, please call me because Paul helps run a private wealth group that gives you access to things that you don't normally see, private bonds and things like that. Call me at 561-305-8226 or call into the show. Paul, any parting shots before I let you go, my friend?
No, I think we've covered it. And again, stay tuned for the inflation watch.
Yes.
And also, inflation has a bunch of different pieces. And I tell you, the most important piece is wage inflation.
Yes, that's right.
Because commodity inflation, such as the rise in the price of a barrel of oil, that probably is transitory. However, wage inflation, once wage inflation is the genie that gets out of the bottle, it's super hard to put it back in. So wage inflation is all you need to watch for.
Yeah, it's kind of hard to run a business, a small business, when you have to pay the high school kid $15 an hour to show up. It's kind of hard, folks. So that you're spot on that. And Again, always a pleasure. Paul Meeks, ladies and gentlemen. Thanks for being on the show with us. Do we still have another call? He's okay. So, it's something to think about. Paul he makes common sense. He thinks he's such a nerd with this stuff, but he's actually cooler than he gives himself credit for, because he does have a common sense approach to it. And look, some people think inflation's good because they say, oh, that means the economy's going and people are spending money. But no, it's not good over a sustainable period of time, because as the cost of, especially for those who are retired, let's face it, that dollar is shrinking in an inflationary period. And every investment that you have has to factor that in. I have a PR firm that they look for different publications, and I was quoted recently. I don't know if they'll use it. One was the Epoch News, and the other was Reader's Digest. And it was basically about how to invest and plan for inflation and the financial planning process. I always try and say to clients that I meet that, look, if the fundamentals start off with a budget. You need to know what's coming in, what's going out. I have a personal Excel sheet that I use, but there are some templates you can buy. There's financial planning software. You can see, because let's face it, if inflation wasn't relevant, then I don't think anybody would invest in equities, because they invest in equities because they realize they need to make more than 2 to 3% on their money if they're going to withstand a 30-year retirement. But it takes a lot of balancing. There's risk in everything. And a lot of clients, the problem is they don't invest properly to begin with, and then they emotionally make changes following the trends in the market. The dog chasing his or her tail. And that's just not how it works. Typically, you have to invest the right way the first time, make adjustments on a small scale, rebalance 5 to 10%, here and there. And it also depends on how old you are. If you're already retired, folks, every dollar means a lot. I mean, Evan, when you go to Publix, it's not getting cheaper, is it?
No, that's why I don't shop there.
Well, where do you shop?
I shop at another big box store.
Oh, you don't want to say?
No. Well, here's the deal. Publix, a gallon of milk, 2% is $4.29.
Unbelievable.
At another store, it's $2.79.
Really?
Oh, yeah.
Well, see, that's the other thing too. When I was quoted in the Reader's Digest article, I said, folks, deals are out there. You have to find the time to find them.
Mm-hmm.
Stop watching TV. So many Americans watch 30 hours of TV a week. It's true. So why don't you take a couple of those hours, go online and shop for the deals? Because every dollar you save is a dollar earned, as the saying goes. And how can you possibly invest if you don't know how much discretionary money you have at the end of each month? I practice what I preach. I don't drive a big fancy car, because that stuff, I don't care about that. I have a nice home. I live within my means. When the pandemic happened, like everyone, it affected my business greatly. But I had enough reserves and a plan to get myself out of it. Now, there is a difference. I don't work for a company. I'm a business owner. So no one cares if I don't get up, shave, and go to work. And it's tough. It's not for everyone. A lot of people do need to punch a clock and just do their job, have a good attitude, and they get paid. I don't know what that's like, folks. But I think we're time for another break. We will be back on Today with Denny.